Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, April 3rd, 2024. Hope you are having a fantastical day out there in the interwebs. It's a pretty nice day here in Colorado. A little cloudy here and there, but not cold, not too hot. So I will take it. So hope you're having a fantastical day. And if it is your first time watching Liberty Call, if you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All right, looks like the market's tumbled a little bit here near the end of the day, so let's go ahead and check out and see what the indexes did. Dow Jones finished off in the red, down 0.11%, 43 points, closed at 39,127. The S&P 500 was up 0.17%, closed at 5214. NASDAQ up 0.23%, closed at 16,277. The VIX fell 1.92% today. It's at 1433. Canada up 0.17, Brazil down 0.2, and same with Mexico. In Europe, Germany was up 0.5%, the UK up 0.03%, France up 0.29%, Netherlands up 0.3% also. Spain up 0.52%, Italy up 0.45%, Switzerland up 0.19%, and Portugal down 0.05%. Russian exchanges both green again today. The MOX up 0.71, the RTSI up 0.86. And the Asian markets, the Nikkei in Japan was down 0.98%, Australia down 1.34%, New Zealand down 1.66%. In China, the Shanghai was down 0.18%, Shenzhen Component down 0.44%, China A50 down 0.31%, DJ Shanghai down 0.25%, Hang Seng down 1.22%, and the Taiwan weighted down 0.63%. So, like I said, the markets were up most of the day. And then actually, let me bring up the chart and we can take a peek at it. There we go. So let's close that. This is the Dow Jones. You can see most of the day, just opened up, traded, near the flat line until about 10 Eastern, jumped up and was above. And then for some reason in the afternoon, dropped down as far as about 0.4% and finished the day, like we said. Similar charts with the S&P 500, except that they did finish in the green, and same with the NASDAQ, also a very similar chart. So what happened in the middle or the late afternoon? I don't know. I haven't seen anything across my headlines that really explains what the heck happened. So, all right, let's get the market recap up here on the screen, and we'll get into it. All right, U.S. stocks climb as Powell says rate cuts remain on the table this year. Sure they do. And let's see what he had to say. U.S. stocks surged on Wednesday following Federal Reserve Chairman Jerome Powell's reassurance that rate cuts remain an option for the year, alleviating concerns that the Fed might adopt a more hawkish stance due to recent robust economic performance. Powell emphasized that while many Fed officials support potential rate cuts, they would wait for clearer signs of sustainable inflation reduction before implementing them. Despite the positive sentiment, Treasury yield saw a slight decrease but remained above earlier lows. The yield on the 2-year Treasury rose 1.6 basis points to 4.685%, while the 10-year Treasury yield increased by 4 basis points to 4.359%. The market received a boost from ADP's report indicating stronger than expected job growth in the private sector for March, with an increase of 184,000 jobs, marking the largest rise since July. However, Intel faced a setback, dropping over 7% after disclosing $7 billion in operating losses for its foundry business through 2023. Attributing the losses to increased competition from Asian rivals like TSMC and Samsung Electronics. Tesla, despite a recent decline in deliveries, managed a modest 0.8% increase in stock value. Meanwhile, Taiwan Semiconductor experienced a 1.4% rise following a halt in production due to a severe earthquake. In corporate news, Walt Disney Company saw a more than 2% decline as shareholders voted to retain existing board members, thwarting an attempt by Nelson Peltz's Train Fund Management to secure 2 board seats. Conversely, Cal-Maine Foods witnessed a 3.2% rise after reporting robust quarterly results driven by record sales, while Paramount Global fell 1.3% amid reports of potential discussions with Skydance Media Company founder David Ellison for a deal. All right, so that is the stock markets for today. So let's get into a little dive into some of the news here. U.S. private employers add 184,000 jobs in March. In March, U.S. private sector, In March, the U.S. private sector displayed robust job growth, exceeding economists' expectations and highlighting the continued resilience of the labor market. According to data from ADP, private sector employment expanded by 184,000 jobs, surpassing the forecasted 148,000. This surge marks the largest increase in hiring since July, with the leisure and hospitality sector leading the gains across various industries. However, the professional services sector experienced a decline in hiring. Despite this, year-over-year pay gains for job stayers remained steady at 5.1%, while job changers witnessed a substantial increase to 10%, notably in construction, financial services, and manufacturing. Neil Richardson, ADP's chief economist, highlighted the unexpected pay gains across different sectors, indicating a heating up of pay despite cooling inflation. These insights provide valuable context ahead of the upcoming non-farm payrolls report scheduled for release on Friday, which will offer further analysis of the labor market's health. Economists anticipate the official data to reveal a moderation in job growth, with an expected addition of 205,000 jobs in March, down from the previous month's 275,000. The unemployment rate is predicted to remain stable at 3.9%, while annual wage growth is forecasted to slow to 4.1% from February's 4.3%. These figures will be closely monitored by policymakers, potentially influencing decisions regarding interest rate cuts by the Federal Reserve later this year. Again, there's just hope that the Fed will lower rates, but I don't think they're going to lower rates until something negative occurs, whatever that black swan is going to be this year. Obviously it's an election year, so the chicanery is going to be off the charts, but we have yet to see what it might be. We don't have a super flu that's rampaging through the country this year like it was 4 years ago. I mean, if you really thought it was. But anyways. All right, next up. This comes from Zero Hedge. It's titled Office Tower Vacancy Rates Hit Record High as Zombie Buildings Litter Skylines of Cities. A recent report from Moody's Analytics reveals that the United States is experiencing the highest number of dormant office towers since 1979. What was going on in 1979? Oh, record high inflation. Yeah, weird. As tracked by the organization, the surge in office space vacancies reached a record 19.8%, is attributed to several factors. Primarily, the rise in remote and hybrid work arrangements has compelled companies to downsize their corporate footprints. Additionally, businesses are relocating from progressive cities and high-tax states to more favorable environments while reducing their office space. Who would have thought that companies would go to places that are more tax-friendly and have better people to employ? I would have never guessed. Despite the increase in vacancies, the commercial real estate sector appears relatively calm. However, concerns loom as the Federal Reserve's interest rate hikes prolong, indicating potential changes ahead, possibly exacerbated after the upcoming presidential election. Thomas La Silvia, Moody's head of commercial real estate economics, warns that the office sector may still face significant stress despite recent positive economic indicators. The current state of high office vacancy rates poses challenges for landlords and developers striving to fill their properties, especially amid difficulties in refinancing due to the Fed's tightening monetary policy. Who couldn't have seen that they were going to raise rates at some point? I mean, you would have thought they would have locked in those loans for a much longer term if they thought that. Where were we? Goldman Sachs, Vinay Viswanathan, highlighted the precarious situation of office mortgages, suggesting that many are living on borrowed time, and that's in quotes. While there haven't been significant disruptions in commercial real estate tower debt, Viswanathan notes that debt extensions and modifications are prevalent, aiming to mitigate potential defaults and losses in loan portfolios. This situation underscores the evolving landscape of office space utilization, with obsolete buildings and neighborhoods becoming increasingly prevalent amidst the changing work dynamics and economic conditions. Yeah, I mean, real estate in general has actually held its value fairly well through at least the last 4 years, and even going back to the 2008 and 9 real estate crisis. That was more residential that was overvalued. Didn't really see a lot of issues with the commercial real estate back then. Yes, there were layoffs and things like that. But, this could really be bad. And even the residential market recovered relatively quickly, back in a decade or more ago. Granted, there were cities like Las Vegas and places like that who had seen just massive expansion and inflation in their housing market. They took it a little worse than other places that, like Houston. I bought a house around that time and it didn't really appreciate a whole lot in the first year or two, but we made out after a decade. We made some money back and it was certainly worth it. All right, last up, got one more article here. This comes from Mises Wire. It's titled "Artificially Low Interest Rates Are Creating Economic Chaos," and this was written by Joachim Book. Let's see what it has to say here. All right. Edward Chancellor's book, The Price of Time, The Real Story of Interest, delves into the intricacies of centrally planned interest rates, echoing concerns often associated with Austrian economics. Despite Chancellor's claim of not aligning particularly with Austrian economics, his work scrutinizes the impact of manipulated interest rates on capitalist economies. Chancellor's book scrutinizes the detrimental effects of a dysfunctional interest rate regime on various aspects of the economy. He questions whether a capitalist system can thrive without market-determined interest rates, emphasizing the importance of interest rates as a rationing mechanism and guiding principle in free market capitalism. Throughout the book, Chancellor meticulously analyzes historical context and contemporary economic issues, drawing on insights from economists and commentators past and present. He highlights the pitfalls of low interest rates, linking them to a myriad of adverse outcomes such as financial instability, inequality, and asset bubbles. Kind of like what we're going through right now. Despite its dense and occasionally confusing nature, Chancellor's book is lauded for its balance and depth. He navigates through complex economic concepts with clarity, although some readers may find the extensive citations and historical references challenging to follow. The Price of Time underscores the interconnectedness of interest rates with broader economic phenomena, tracing their evolution from ancient Mesopotamia to contemporary monetary policy decisions. Chancellor's examination of interest rates' impact on investor behavior, economic productivity, and financial markets offers valuable insight into the functioning of modern economics. Ultimately, Chancellor's book serves as a thought-provoking exploration of the role of interest rates in shaping economic outcomes by challenging conventional wisdom and offering a nuanced perspective. The Price of Time contributes to ongoing debates surrounding monetary policy and economic governance. And I can count on the fact that no one at the Federal Reserve will probably read this book or take it into advisement because they don't really seem to care about the little person like you and I. So, all right. Well, that is everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you, yes, you in the brown shirt out there, I see you sitting there. I hope you have a wonderful evening, and I shall talk to you next time. Adios. There we go.